all real meals all week so far. So that, I mean, I won't cheat on that. I'm very.
So what protein are you eating? What is she having you eat?
Well, she hasn't, I don't have like a meal plan. Really, my goal is to eat food. That's the main thing for me. But like, I ate a turkey sandwich yesterday at the Point Mortgage meeting, and what did I have for dinner last night? Oh, I had Greek yogurt. And I just kind of, I don't meat wise. I mean, I've had some chicken and I had that turkey sandwich. That's always the hard part. Greek yogurt is protein, but
well, good, because
protein bars, I'll have those for breakfast.
Yeah, because you're working out now. You have to eat. People don't realize if you're working out a lot and working out every day,
it's like yoga, like it's not like but yes, it's definitely, I'm still like getting a workout, and it's pretty good. So, anyway, I don't want to be on camera. I've got to go get ready for work and listen. But thank you for taking over for Tony.
Yeah.
I mean, not for Tony, for Corey.
No problem.
Okay, I'm going black.
I'll see you later, probably.
Okay, I'll be at Liberty Station after I get ready and go. Okay, adios.
Okay. Good morning, Jim O'Donnell.
Good morning, everyone.
Not too many on camera this morning. And Chuck, are you there? No, he's probably still in hair and makeup. Getting ready.
Hair and makeup.
You.
Angie, what'd you say?
That if he doesn't show up, it's fired up Tony Friday or something.
No, he's here. He's got his, he's on. It just wasn't sure if his audio was on yet.
Oh.
Morning, Russ. Happy Friday.
Hey, happy Friday to you. Look at that. It's 2 days to my favorite national holiday.
Which is?
May 1st.
What's May 1st? Why am I blanking out?
That's my birthday. That's my birthday, national birthday.
You're right. Good for you.
At least in my household, it's a national holiday. Did it seem like a little crazy week this week? Seemed a little crazy.
Yes. It's a very weird end of the month.
Yeah, agreed. Seems like a lot of action going on out there.
Yeah, a lot of action. I mean, we had an increase in listings taken this week. This was really nice to see, but they're already gone. That buyer pool seems to be very strong still. So I can't hear you, Chuck, if you're trying to talk.
No, I haven't talked yet.
Okay, there you go.
No, I'm actually just still waiting to get into the waiting room though. Here, I'm just not sure if it's my computer or.
Yeah, I don't see you in the waiting room at all.
Oh, okay.
You did a nice job with your hair and makeup today, Chuck.
Thank you. I spent 4 or 5 hours on it this morning. You know, I knew Mary Beth would be on it, and I wanted to look good.
Exactly.
Yeah, it's weird. It must be
4 or 5 hours. My goodness.
Every day.
Question for you guys. Do you think with more inventory coming online, therefore there should be more sales because the amount of buyers really hasn't dropped off, right? Is that what we're is that everyone's consensus?
Okay. Sorry, Russ. I'm still having a problem getting in. What was your question?
My question was, it looks like there's more inventory coming online, right? So if there's more inventory and we still have approximately the same amount of buyers, shouldn't we have more sales down the road?
Oh, for sure.
Like more units sold?
For sure.
Yeah, right? So it's actually going to be a really, really good market.
We're about ready to make our June run, everybody. This is, the June, July closing months like last year, which was the biggest one since I've started tracking for 25 years. I think this next window of the next 60 days is going to be insanely awesome. I think Tony's going to be counting his money. I think it's going to be crazy, which is kind of what we're going to be talking about today, which is if you do make this money, which is coming up, what are we going to do with it? So, Tony, I was kind of hoping unfortunately, I'm not able to get in today. Which is unfortunate, but that's on me. It's on my 90-year-old iPad. So I was ready to roll, Tony. If you are,
let's give it a minute here.
All right, that gives me time to try to log in while you're waiting.
Yeah, let's try that.
You got it.
Morning, everybody.
Oh, good.
Morning, Steve.
Steve, I am so glad you're on because we're going to be talking a little bit about somebody a little bit about Warren Buffett, and I always am looking forward to your feedback. So I think I'm really glad you're on. I almost texted you this morning, Steve.
Thank you, bud.
All right, let's go in.
I try to log back in. Let me see if I see it.
There we go.
There you are. I see you now.
Thank you.
Good morning.
Good morning. Good morning.
Good morning. But to get back on Russ's question, we're on point. We're on like the right path to have probably a very similar year if it continues at this pace where I don't know if we're going to hit 50,000 homes sold in San Diego County like it did last year, but it'll probably be, 45,000, maybe 42,000 homes, which is above average for the year.
Good. All right, Tony, I say we roll, man, even with the people we have, because I know there's quite a few on Facebook too. Is that cool?
Let's go.
All right.
Excited.
All right, so I'm excited. We're talking about one of my favorite topics again today, which is money and what you're supposed to do with it. What we should be doing in today's market. Should we be buying? Should we not be buying? Should we be investing in the stock market? Should we not be investing in the stock market? Basically, I think there's a lot of fear out there right now, and I think you guys would agree that, oh my God, am I buying at the top? What should I be doing with that money? Should I be waiting? And I'm sure you're dealing with that with your clients too. And so that's what I wanted to address a little bit. And I wanted to address it through this. And I know you can't really see it, but this is called The Psychology of Money by Morgan Housel, and it's one of the better books that I've ever read. And I wanted to share some of the theories with you guys of that book. First and most important is money has little to do with how smart you are and a lot to do with how you behave. And that's really what this comes down to, is that behavior is hard to teach, even to really smart people when it comes to money. And I am really sorry that you're going to see all this text. You don't need to pay attention to all this stuff. It just is what it is. But a genius who loses control of their emotions can be a financial disaster. The opposite, ordinary folks with no financial education can be wealthy and have money kind of beyond their wildest dreams. And it's because they have a handful of skills that have nothing to do with intelligence. And I want you guys to think about people that you know who are, maybe not the sharpest tools in the shed. They're not nuclear scientists. They're not engineers. Yet somehow, some way, they've accumulated millions and millions of dollars over their lives. And I wanted to give you an example, which is a guy named Ronald Reed. And Ronald Reed was a janitor. He was a gas station attendant. He spent 25 years as a janitor at Sears back in the day. And he bought his first 2-bedroom, 2-bath house at the age of 38. Unfortunately, he was widowed at age 50 and he never remarried. And he ended up dying at the age of 92. Now, this is how he spent his life as a janitor and a gas station attendant. This is Ronald Reed. Now, when Ronald died, unbeknownst to his stepkids, nor to a local hospital and library, he left $2 million to his stepkids and $6 million to a local hospital and library. Now, they didn't even know that he had money. And he started with nothing, by the way. He was not born into it. He did not win the lotto. It was nothing special. It was the way he lived his life and the behaviors that he used to live that life. So that $8 million that he kind of created and left to everybody shows that he has something that many other people don't. and that is the right behavior patterns, which we're going to talk about today. Here's what's a kicker. In 2014, 2,813,503 Americans died in 2014. However, fewer than 4,000 of them had a net worth of over $8 million when they died. So think about that. Over 2.8 million died, and only 4,000, less than 4,000, had $8 million. Now, why is that? Why did these people have $8 million when most Americans died with next to nothing? And that's all going to come down to mindset and the way we look at things. So the next one is Ronald Fuscon. And Ronald Fuscon was a Harvard graduate. And Ronald Fuscon was a medical doctor. He got his medical degree from Harvard. And he retired in his early 40s. And when he retired, he tried to do the same thing that Ronald Read did, which is tried to leave money to, some, or was planning on leaving money, gave some away, was trying to become a philanthropist. But he decided that everything started to fall apart for him when he started to kind of expand heavily in his homes. He bought rentals, he bought all kinds of stuff with the money that he had. And then 2008 hit. And when 2008 hit, I know many of you guys were on this call, that are on this call were here in 2008. I know I was. And I would say of the 200 agents we had in our company at the time, I would say at least 50 of the agents that we have lost their homes. And here in this particular valley, in Menifee, Murrieta, Temecula, Canyon Lake, this area, the average sales price dropped 65% beginning in 2008. I don't know what it was like for you guys down there in San Diego, but we got murdered here in this particular area. Well, guess what? Ronald was one of those people that got killed. He lost his home, including one that he had in Greenwich. He had one down in Florida. He had one with a pool in it. And the scary part about this is at his bankruptcy hearing, when he was talking to the judge, he said, "I have no income, Your Honor." So when he was doing his bankruptcy negotiations, he literally said, "I have no income." So this was a guy that retired, was a heart surgeon, was basically one of the most successful people on the planet at that time. And then within a certain amount of time, he was claiming bankruptcy. And the reason is because he has the fatal flaw, and that fatal flaw is he did not create income paths and income streams. Now we know that finance and money and all that stuff is taught kind of in a math-based field. It tells you what to do and how to get your returns and how to get your cap rates and do all that sort of stuff. Example, putting 10% of your salary aside, all that sort of stuff. So it's math. You do this, you do this, you do this, you're going to get the results. But the bottom line is if you are not creating income paths, if you are not doing all the things that you need to do with your money, so not just making the money, but keeping your money and then helping that money grow, then you're going to end up like Fuscon, which is in bankruptcy. And this is where I think it gets really, really interesting. And this is the stuff that I get really excited to talk to you guys about, is that money is everywhere. And it affects us all and confuses most of us. I think money's everywhere, but it does confuse us. We don't know what to do. We get paranoid. We get worked up. But it offers so many lessons in life. Things like risk, things like confidence, things like happiness. There's so many things that the influx of money comes in and teaches us throughout our lives. And this is what I like to call the greatest show on earth. And I would say if I were to think about one of the things that I would consider to be a hobby, it would be watching what people do with their money. It's watching the people that rise to the highest heights and then claim bankruptcy. It's people that start at zero and end up becoming multimillionaires. It's my friends that I've seen that have exceeded my most wild expectations. It's my friends that I expected would be absolutely amazing multimillionaires and ended up with nothing. So it really is the greatest show on earth if you sit back and start analyzing it. And I'm talking about your friends, your neighbors, your parents. How are they treating that money? How is the circus of their financial life unfolding? And you guys get the opportunity to watch it at all times. And I get really excited about that because it's, that's obviously how we learn. And when I say it's how we learn what to do, and it's also how we learn what not to do. I mean, it goes both ways. So you watch some people and you can learn lessons from their positives, and you can watch some people and watch some from their negatives. And I've always thought about, and I know you've heard me say this before, but that Successories poster where it shows this giant ship sinking in the ocean. It's a real picture. It's an anti-Successories poster. And it says, what if the purpose of your life is nothing more than as to serve as a warning to others? So we don't want to be the people that have squandered opportunities, have not made the most of our financial opportunities, have not set a positive example for our kids or grandkids or nieces or nephews or whatever. We want to be the people that can show them the path that they can follow so that they can have some level of financial success and enjoy life and not have to deal with all those fears. So when I say the greatest show on earth, it really is a great show to watch other people and to watch what they do. So that being the case, I just wanted to ask you guys a couple of quick questions. And Tony, I hope you don't mind. I'm going to pick on you a little bit. And my question, Tony, would be, do you know any people in your family that you would look at them and meet them and you wouldn't know it, but they are some of the more loaded people that you know and you would never know it because of the way they've lived their life?
Absolutely.
Who do you think of, Tony?
I have an uncle who you would never think that he's loaded, and he's loaded.
Loaded.
He lives very minimal, not extravagant, but he's loaded.
So he lives minimal, and because I've always said, Tony, and this is my favorite line, and this is what I hope for everybody on this call. I want you to be the richest person in the room, and nobody knows it. And that sounds like your uncle. Does that sound about right?
Yes.
All right, cool. So all right, so the next piece is when I say watching people with their money and what they do with it, like I said, I really enjoy it. So let's do it. We're going to jump into a little bit of the details of the psychology of money now. So everyone has their own unique experiences of how the world of money works. And I'm talking about Adam, my video guy over here. I'm talking about me. I'm talking about Tony. I'm talking about Mary Beth. I'm talking about everybody on this call. We were all born to different situations. We all have had different demographics, come from different demographics. Our parents, our relatives have all had different jobs. We've had different incentives. We've had different luck. We've had different generations that have taught us things. We've had different parents. So everybody in the world, whether you were born in India to a poor family or whether you were born as a Kennedy, we all have these different views of how we were born and how we view money. So understanding that everybody comes from a different place, we're all going to have a different assumption of the way money works and how to accumulate it, how to create it, how to keep it, how to grow it based on the experiences that you individually had in your life and the way you were raised. So everybody on this call has had a different show that's driven them to where they are today. So the person who grew up in poverty is going to think about risk and reward in ways that a child of a wealthy banker cannot fathom if he tried. So a lot of you guys on this call and could have grown up, extremely, extremely rough, extremely, extremely poor, and you're going to have a different view than somebody that was, obviously born into wealth. So that being the case, I think we can look at it in a few different ways. So for me, and I don't know about you guys, but I was raised and I was born to two 15-year-olds. My mom has still never owned a home that she's lived in. So I grew up, understanding that money is tight and that it's very difficult, and I'll just tell you guys an example that I had when I was young is, and I'm sure you all have these examples, but I remember my dad had this piece of shit little beige pickup truck, and we were driving down to Texaco gas station to go get some milk. And we were driving in the car, and he said, "Chuck, do you know why we're going to Texaco?" And I said, "No." And he says, "Well, we have no money in our checking account. We have no money in our savings account. All the credit cards are maxed out. And the only thing that we have right now is this Texaco card that we have credit on that we can go down and buy milk and stuff like that." So we were grocery shopping at the Texaco gas station. So because that's where the credit was left at that time. So things like that, those sorts of things are going to mold you into who you are. And so the reason that I am considered so cheap, the reason I am such a saver, the reason I believe such in passive income and all those sorts of things is because I was molded by that moment. And lots of different moments, right, growing up. So, and I'm sure you guys all were too. So the way you are and the way you think about money is directly linked to the way you grew up. And I know everybody on this call has their stories. And everybody has something that drove them to be the way they are. Now, that can be good or bad. So for some people on this call, it can be a limiting belief. So if you were raised poor, you think that's how you're supposed to live. Or if you were raised poor, that's what motivates you that says, hey, you know what, F that. I never, ever, ever want to be poor. So when you tap into yourself and you look back to that makeup I was talking about, to the way you were raised and your demographics and your situation and where you were at geographically and all that sort of stuff, it's going to either help you or hold you back on the decisions that you make in your personal and financial life, your personal financial life. So I think it's important that you realize that those little limited beliefs can be a problem for us, or they can be the fuel that rockets you. So this is something I was thinking about, and I when we put out the piece today, I asked them to throw on there, investing in today's market. Is today a good time to invest? So I don't know about you guys, but a lot of people have kids right now that are watching what's happening with this market that we're in, this real estate market, where in my area here, in Temecula, for example, prices have gone up 52% over the last 3 years. 52% over the last 3 years. Now, I have sons that are watching this, right? They bought a home a few years ago. They're watching what's happening to it. So they're being kind of molded by this inflationary market that we're having. They understand that rates were at 3%. All of a sudden, they're seeing the cost of groceries go up. My son, who's in college, called me up and he's like, "Dad, I just paid $15 for 3 pieces of chicken." And I said, "Well, that's called inflation, son. That's the way it works." So if you were raised in today's inflationary market, they're being molded on the way they're going to see money forever. For somebody like Tony and Tony's age and my age, we were hit and bitch slapped in 2008 and got to watch exactly how that all unfolded. So that changed us to the point where, if I know Tony, Tony's never going to let that happen to him again. And most of the people on this call are never going to let that happen to him again. So I think it's important that we know, again, where we're coming from and how our kids, our nieces, our nephews, how everybody is being molded today. So my son gets a few bucks, and I'm sure you guys have people that are the same. They're dumping all their money into stocks right now. Do you guys know a lot of people that are dumping money into stocks? And they're doing it because the stock market is insane. And they see that that's how it is. So in inflationary markets, everybody thinks, oh, success comes from investing in the stock market. Well, again, in the past, that wasn't the case, because it might have been about investing in real estate, because you started buying in 2013 or 14. So again, how we're all going to view money is kind of the point. So there was an example about, and I think if you look at your grandparents, and I know my grandfather picked peaches in the Depression, and he did it with his father, they were both in real estate sales, actually, and then they lost everything in real estate sales during the Depression and actually went out and had to go pick peaches. But they were the ones that used to stash cash in their mattresses, and I'm sure a lot of you guys have grandparents and things like that had to do that too. But their experience of the way money works is very different than the way mine was when I was raised in the 80s. Listening to the Material Girl by Madonna. So, it's very different. So anyways, that being the case, we just, again, have to realize, so what's happening in today's market and how is that molding us? And your personal experiences with money, everybody on this call, whether I'm Mary Beth or whether I'm Jen, is your personal experience with money and the way you were raised makes up 0.000000001% of what's happened in the world's financial markets, but 80% of how you think the financial world works. 80%. So people make their investment decisions based on the characteristics and investments available, and most importantly, their experience over their lifetime. So what does that mean? Spreadsheets can model with historic accuracy what's happened with big stock market declines, what's happened with real estate, but they can't model the feeling that we've had coming home and looking at your kids and wondering if you made a mistake because you bought a house in 2007 at the very top of the market and it's already lost $300,000 within a year and a half. So, or my experience with my dad with the Texaco card, and not being able to do that. So those feelings are going to be more powerful than what's happened with spreadsheets. So we have to get back to, sorry about that, guys. So we have to get back to really kind of taking a look at the spreadsheets and what's happened with the economy and what's happened with the market over this time, and try to bury some of these feelings from the experiences you had, but that's still going to have an overall effect on us. So history makes you feel like you've understood something, but it's the personal consequences that are going to change your behavior. And in World War II, this is what I think you're going to like this. And I hope everybody's listening to this, because I thought this was one of the coolest parts of the psychology of money. Prior to World War II, did you guys know that there was no retirement system? Did you know that? There was nothing. It was just getting started. Basically, you worked until you died. And the only way that older people were taken care of was being taken care of by their family members. So there was no Social Security and all that stuff. That's all like within the last 100 years. Only by 1975, only 25% of Americans had a pension. Think about that. I'll bet some of you guys were, just being born, we were around, that only 25% had a pension. The 401k, which is used in most companies now, that was created in 1978. Like, this is new. And the Roth IRA, which I'll bet a lot of you guys on this call are invested in, 1998. So think about that. Before that, there was no such thing as retirements. There was no such thing as Social Security. Obviously that's come about in the last 100 years, but now, as of 2018, there's $27 trillion in U.S. retirement accounts. $27 trillion in U.S. retirement accounts, making it the main driver of common investor savings and investment decisions. So this is the big kicker. It's no surprise that many of us are bad at saving for retirement because we're all just newbies. Does that make sense? It's not like there's generations and generations and generations of people that had retirement plans and pensions and all that stuff. Literally, your parents were some of the first people that ever had a Roth IRA, first people that ever had a pension, first people that ever had a 401k. So we're just newbies, so we can take it a little bit easy on ourselves understanding that. So we all do crazy stuff with money because we're all relatively new to this game, right? The money game is newer. And we've been making our decisions based on our unique experiences. So that being the case, I can move on to the next two people. And here's where I wanted to get you involved, Steve Games. Financial success requires luck and risk. And Steve Games has always said that if you want to have great profits, you have to take great risks. That's what he's always said, and I agree with that. But I also believe that it's tied in a little bit with luck, and that's one of the things that I wanted to talk to you about. So I'm going to start here, Steve, with Bill Gates, but then I'm going to move on to Warren Gates, and I would love it, Steve, if you don't mind jumping in. So Bill Gates, 1978. 303 million people in the world were high school aged. 18 million lived in the United States. 270,000 of the high school people lived in Washington State. 100,000 lived in the Seattle area, and only 300 went to Lakeside High School. The kicker with Lakeside High School is that Lakeside High School was one of the few schools in the entire country that had something called a computer on their campus. One of the very, very few. They say something along the lines of the 303 million people that were high school age, there was only one computer for every 1 million high school aged kids in the world at that time. So that is the luck piece that I'm talking about. So one computer for every 1 million high school kids at that time. So Bill Gates just happened to be one of the 303 million people, which means there was probably only 300 computers in the world in high schools at that time, but he went to Lakeside High School. So Bill Gates' quote was, if there was no Lakeside, there would be no Microsoft. Now, yes, he was smart and he was hardworking, but he also had the CPU, which was his luck. So it was those two things that lined up for him that gave him both of those things that created, obviously, Microsoft. And Bill Gates once said that success is a lousy teacher, though. It seduces smart people into thinking they can't lose, which is something we're going to talk about next. But just remember, and this is the message I want to get across to everybody. When things are extremely well, realize it's not as good as you think. You are not invincible, and if you acknowledge that luck brought you success, then you have to believe in the luck's cousin, risk, which can turn your story around just as quickly. And the message I want to get across to everybody is, everybody's made a few bucks over the last couple of years. Making money is almost easy. The hard part is keeping it. Oops. So the hard part is keeping it and making it grow. So that's what we're going to kind of move on to next. So just remember that the luck that you've had, and I want to say this, and Steve, I was at a broker conference with Peter and with like 500 brokers this weekend. And even for the broker level, even though obviously, splits have gone up and commissions have gone down and people are getting 2% and all that sort of stuff, I think brokers and managers and real estate agents need to remember one thing. And that thing that they need to remember is it's not all you. It's the market. It's this market that has given you the opportunity to make the kind of money that you've made these last 3 years. Had this market not done what it was, you might not have had the same opportunities. So we think we're invincible. We think we're great. We think we're amazing, when really a lot of it was luck that helped us get here, because we did not know as we moved into COVID that we were going to move into this sort of a market. So I just want to make sure that we don't get too big for our britches and think we're invincible. And everybody's got a few bucks right now. And even random people have a few bucks right now that they're investing in. And I want to talk to you about what to do with that. But any feedback on any of this stuff yet, Steve Games?
Because can you hear me, Chuck?
Yes, sir.
So that one quote that you gave when you were talking about risk, John Maynard Keynes, who was one of the super analysts of our time, in the beginning of his primer book on economy, basically said that profit is directly proportionate to risk. So that connects to what Bill Gates had said as well. So you've got to risk a little bit, but a lot of the message that you put out, and I agree 100% with, is that you can't risk 100%. You need to absolutely be sure that you're taking 10% of that at least and putting into a secure, non-risk investment.
Right. And I like that, Steve. And that's why right now we're going to move on to Warren Buffett. And I know that there's been like 4,000 books about Warren Buffett.
Start working crazy in a minute.
But there's a couple of things here particularly that I think we have to remember about him. So we mentioned that failure can be a lousy teacher. It seduces smart people into thinking that. So we talked about, smart people making bad decisions makes them more fearful of making other decisions in the future, and it makes them avoid risk. And we've all made bonehead decisions here and there in our lives when it comes to money. But the trick in dealing with failure is arranging your financial life in a way that bad investments here and missed financial goals there won't wipe you out. But you can keep playing until the odds are all in your favor. And I really want people to kind of hang in with me here, because this is where all of this starts to get really good. And you guys know I'm pragmatic. Like, I like to talk about self-employment pensions. I like to talk about corporations. I like to talk about trusts. I like to talk about all that stuff and how you can make money with that. But it's really going to come down to a mindset. And Warren Buffett is the one person on this planet that has it figured out. And I wanted to share with you a little bit about why he is considered the greatest investor of all time, or at least one of the greatest investors of all time. So, and I know you've met him, Steve, and I know that he bought your company and all that sort of stuff. So anytime you want to jump in on Warren Buffett, please do. And I'm going to give you my assessment of the lessons that we all can learn from that. So I don't know if you guys know this, but by the time Warren Buffett was 30 years old, he was worth $9.3 million. $1 million in his time. $9.3 million adjusted for inflation. I think that's pretty significant. By the time he was 50 years old, so hear me out, guys. By the time he was 50 years old, he was worth $300 million. Okay? So this is such a badass stat, guys. $81.5 billion of Warren Buffett's $84.5 billion net worth came after his 65th birthday. Can you guys believe that? Did you guys hear what I just said? Is that pretty crazy, Carrie Guthrie? 81.5% or billion of Warren Buffett's $84.5 billion net worth came after his 65th birthday. And I've always told you guys, and I believe this, that your kick-ass prime earning years are between 60 and 70. And I'm going to show you how he went from 300 million at 50 to 84.5 billion after his 65th birthday. And I think it's really inspiring. And it's because of what he learned along the way in his life. And then all of a sudden, it clicked, and all the hard work that he did when he was younger started to pay off. So here it is. So think about this, and this goes for a lot of you guys out there. If Buffett had retired at 60 and decided to play golf and spend time with his grandkids, his skills would have in investing would have just disappeared. It wouldn't have mattered. He wouldn't even have made the chart. So a lot of people like to retire early. They want to do this, they want to do that, when really your badass years start at 60. Warren Buffett compounded his interest at 22% annually. So what does that mean? That means that if he had $1, then the next year it'd be worth $1.22, and then the next year it'd be worth $1.46. So his secret was compound interest, of having investments where the money continued to come back to him and he didn't spend it. So again, compounded interest, the money came back to him and he did not spend it. He continued to try to compound it. Compounding interest is what created Warren Buffett. Now, was he a genius and able to get 22% annually? Absolutely. Can most of us on this call do it? Absolutely not. That's not us. But we have the opportunity. And when I say we have the opportunity, here's what I mean. Rental investments is what you've always heard me talk about. Rental investments, loaning out money, all those sorts of things. So the point is that what seems like small changes in growth, which could be the 6%, assumptions can lead to ridiculous, impractical numbers. So Steve, the real secret to Warren Buffett is, you know, and you've heard the crazy stories about how, you know, still later in life he was driving a 1982 Ford pickup. And the reason that he was is because he did not want to spend money on cars. He did not want to take that cash out because it was less for him to compound and to compound and to compound. So for us, when we go buy, you know, a $60,000, $70,000, $80,000, $90,000 car, that's something he would never do. And the reason that he would never do that is because he didn't want to pull that money out and not get the return, which stacked upon each other to create what was $84.5 billion by the time this book was written. So compound interest is the key. You guys have that opportunity that I've talked to you about a million times about before, and I'm always going to keep telling you this until I'm blue in the face. Self-employment pensions. Self-employment pensions, and I'm sorry to bring this up again, but I have to because I know a lot of you guys have not set up your self-employment pensions. The cool part about it is I make $100,000. I can put $25,000 into a retirement account. When I put that $25,000 into a retirement account, again, that money can never be drawn out from me until I retire. But as I put that money in that account, what happens is I invest that money, and when I do so, the money comes back into that account, and I don't have to ever pay taxes on it until I pull it out when I'm in my 60s. So if I put in $25,000 a year starting at 40, I'm going to put $25,000, I'm going to get a little bit of a return. Then I'm going to put another $25,000. Now I'm going to have 40 plus that return. And then I'm going to buy a rental. And then I'm going to loan out money to Billy. And then I'm going to make a loan to my client for $15,000. And I'm going to charge them $1,500, you know, or whatever that may be. And it starts to compound. The cool, amazing part about your opportunity as a real estate agent is that you can create self-employment pensions. We're the only ones that can do that as independent contractors and sub-S's. So again, it begins to compound over time. I got lucky. And I started my self-employment pension at 26 years old. So I have been fully funding 25% of my income for my entire life into that account. You know, there's up to a maximum, of course, and investing that money to where now I have rentals and commercial buildings and loans and all that sort of stuff in that account. Now I can't touch that money, but the fact that the government can't come in and swoop out 40% for your taxes means that that money just keeps growing and growing and growing and growing. So what Buffett was doing is he had obviously vehicles where he could create more and more and more compounding investments that continue to go back into accounts and grow them at an astronomical rate, which is the lesson for you. I'm not telling you to be Warren Buffett, but I am telling you by having a self-employment pension or by having your money in LLCs or in certain vehicles, you can start stacking what little money you have because it's going to grow exponentially. Remember, Buffett didn't get to the big bucks until he hit about 65 years old, and that's when it all started taking off because he had saved a little bit of money and been compounding it, and then boom, he hit 50 and it started to take off, and then he hit 65 and it skyrocketed. So the lesson in all this stuff is put yourself or your money, 25% of it, in a self-employment pension, and that's what I want you guys to do. Put it in a self-employment pension account. Now for some of you guys, this is the same kind of thing. Like if I'm Tony, obviously you're not a self-employment, you're not self-employed, so you're W-2'd, so your money's stacking in a 401k, right? I'd assume at Tycor your money's stacked. It's the same thing, right? So as long as you are putting in the maximum contribution, Tony can't pull that money out. He's got it in the stock market. You know, I don't know where you have it invested, Tony, but it's going to keep growing and growing and growing. So people that don't have maximum retirements going on are missing the fucking boat. Excuse my French, but if you are not putting as much money into your retirement, future you is going to be so pissed that you didn't do it. So I want to make sure that you guys are funding your retirements, funding your pensions, so that someday you can be floating down at Steve Games Resort down there in La Paz, happily having a cocktail, thanking yourself for the shit you did today. So that's why I want you to be thinking about self-employment pensions, right? And thinking about funding your 401ks and making your husband or your wife or your brothers or your sisters or your kids fund those things to the maximum that they possibly can. Well, I'm only putting 1% in my 401k. Come over here so I can slap the shit out of you. All right, you need to be putting in the max every single time, or someday you're going to be regretting it. You're going to be Fuscon earlier, the guy we talked about. So here's an example. I bought a house, and I think you're going to like this, guys. And I'm never sitting here to tell you how smart I am, because I'm not. I've been lucky, and I've had people that have coached me. So I bought a house for $135,000 back in 2013. And any of you guys that were in the real estate market in 2013, that was literally the average sales price around this area. And by the way, that was 9 years ago. 9 years ago. Okay, this house now goes for about $550,000. It was not a deal. I put $30,000 down when I bought that house. Now this is just an example that I'm using. I got a payment of $900, and I rented it for $1,300. I put $30,000 down. I rented it for $1,300, and I had a payment of $900. So I cleared about $4,800 a year. You guys with me? Everybody understand that? So I was making about, and hey, $4,800 a year on $30,000 down. Yes, that was a killer investment. That got me a 16% return. But, and here's what I want you guys to remember. That $30,000 down now rents for $2,500. And to be honest with you, in these rental markets, it's probably more than that. I could probably get more than that. So now my payment is still $900, right? Because it doesn't go up. I'm clearing $19,200 per year. So if you were to look at the $30,000 initial investment that I had, 9 years later, I'm now getting a 64% return on that $30,000. You guys with me? Does that make sense, Tony? So again, I'm not Warren Buffett. I'm a schmuck real estate guy that's just trying to figure things out. But I do know that the purchases that I made earlier on in life are now bringing me a 64% return on this particular thing. Now, come on, I got to make my mortgage payments. I got to do all that sort of stuff, which is great, but I still am netting out 64%. So for you, you need to be realizing the same thing. So back in 2006, when the market was at its top, this house that I paid $134 for, yes, it peaked out. It was probably $240, so it lost almost $100,000. But it's going to go up. So even if you are buying today, it's going to go like this. And I'm going to show you exactly what happens and why you should not be afraid to buy today. And I still do not think it's the worst idea. You got to make it pencil still. And if you are buying a rental or doing anything like that, you guys can call me and I will always pick up the phone and tell you, well, here's what I think about that. Here's the cap rate. Here's the return. Let's talk about what are you putting down, what's your, all that sort of stuff. So anybody that's part of the Coldwell Banker family, I will help you guys anytime. Just call me if you just want to get an outside opinion. But so the first time most people see a compound interest table, and I don't know if you've ever seen a compound interest table, and I'm going to pick on you again, Tony, is if you look at have you ever seen the ones where it's like, if I put in $1 a year or $1 a day, when I'm 16 years old, as a compound, and I get a 6% return, what's it going to be worth when I hit 60 years old? And it's something like, millions and millions and tens of millions for $1 a day because it compounds over time. Now that's the difference between funding my stuff and compounding my interest in my 20s versus my 30s, which will have a massive difference in the amount of money that you end up having at the end of your lifetime or as you start hitting 50s and 60s and all that sort of stuff. So compounding interest is everything. And it's a life changer to look at a compound interest table because all of a sudden you're going to see if I make these little teeny tiny contributions, the massive effect it's going to have overall on my life. So compound interest is everything. Hey, Tony, I feel like I'm talking too much, man. Am I preaching here? Am I getting all crazy?
No, this is awesome. This is, and I love the realness because I think people really need to hear this. Well, absolutely, they need to hear this.
Thank you.
Hey, Chuck, it's Russ.
Hey,
Can
Russ.
you jump on real quick about the power of 72? You know what the power of 72 is.
The power of 7.2?
Yep.
So, yeah.
72.
Yeah. Well, I don't know if we're talking about the same thing, but if you have compound interest, and let's say that I give Russ $100, Russ has $100, and Russ gets a 7.2% return. So Russ invests $100, he gets a 7.2% return his first year. So now he has $107.20. and then it's going to go up another 7.2 the next year, another 7.2% the next year, and by year, was it year 10, right, Russ? By year, was it year 10? Or 8?
Yeah, year 10. Year 10.
By year 10, your investment has doubled. So your $100 is now worth $200 if you can get yourself a 7.2% return in 10 years. Does that make sense? So
yep, and
go
the
ahead,
beauty
please.
of that is with real estate, and you touched on this already, is that you get to leverage real estate. So you took $30,000 and put it down, right? Mm-hmm. And then you've got cash flow, which you're getting a great return on.
Right.
But if you average 7.2% on that purchase that you made, that was roughly $200,000, if it goes up 7.2% on average in 10 years, it'll be worth twice what it was.
Right.
And you didn't even take into account that into your return yet.
Right. Right. And you know, Russ, and I'm going to say this to everybody on this call. One of the things that I find extremely frustrating is I have some friends that are still renting. And do you guys have friends that are still renting out there and, you know, have not bought a home? And the kicker with that is go out there right now, guys, and try to find yourself a rental and see what you're going to be paying for rents in San Diego County, in Riverside County, in Temecula. See what happens. Because what you're going to find is that had they bought that house that I just showed you guys that I bought back in 2013 with a payment of $900, that house is renting for $2,800 now. Renters don't realize that when you buy real estate and you get a mortgage payment, with your point, that you are forever going to be at that payment. Yeah, your property taxes are going to go up 1% a year, but your payment is locked. So people going out and looking at rentals now that have been waiting to buy, and I'm going to wait for the market to drop, and I'm wait for this and wait for that and all that shit. Well, guess what? Now they're paying $2,800 for a piece of shit rental, when if you go buy a piece of property now, you're going to be locked in at that payment forever, because rents are going to continue to do what, guys? They're going to continue to go up. And so it breaks my heart to see my friends and family members and everybody renting and waiting for the market to change. And they've been waiting for 10 years for this great opportunity as their payments continue to double. So it makes me sad that that's happening. But from the investor's point of view, from your point of view as an investor owning a rental, my $900 a month that I was renting that property for, that's now bringing me back $2,800, I'm now clearing, what, $1,900 a month on that thing? But some poor renter who decided not to buy has to pay that, because that's what the market. I'm not trying to be Mr. Greedy. I'm just at market rents. So you have to remember
the rent compounded just like your investment compounded, right? Their rent is compounding on them.
Yeah, and it just breaks my heart, Russ, you know, because I have such dear friends and such dear family members to see them still renting and to watch what's happened with rental rates. I mean, you know, we had a rental pop up and there was a small showing that was going to happen for that rental, and they had 32 groups outside. And the house was going for like $3,000. And 3 years ago, it was rented for $1,600, guys. Doesn't that just blow you guys away? You know? By the way, does anybody else have anything they want to jump into this stuff? Because I'm really sorry I get so preachy on you guys, but once in a while I just feel like I got to do it. Mary Beth, any comments on any of this stuff? I'm always interested in what Mary Beth has to say.
No, thank you for being so fired up for us and being supportive of us getting wealth in our real estate business.
Well, thank you, Mary Beth. And I know you're really smart about it. So I want you to know I appreciate you. And I know you got apartments and all that fun stuff. So anyways, good stuff. So all right, so let's keep moving. Warren Buffett. So again, for Warren Buffett, it's not about economic cycles. It's not about creating strategies or sector bets or whatever. It's about the fact that he learned about compounding interest. And compounding interest and having investments and putting money in and never taking it back out, never taking out the rewards of your investment and letting that compound is the real secret to his success. And that's going to be the same thing for all of us on this call. The secret to financial success is compounding interest. Getting a rental that you're getting 7.2%, and like Russ said, it'll double in 10 years. On top of the fact that you got all the appreciation that in the last, 10 years has tripled. The house I bought for $135 is now probably $580. So that's tripled. Rents have gone, all the way from my $900 payment to $2,800. So investing in real estate is where it's at. And no matter what's happening with the economy, I'm going to show you some really crappy charts here in a minute, but good investing isn't necessarily about earning the highest return. It's about earning pretty good returns, decent returns that you can stick with and that can be repeated for long periods of time. And then all of a sudden, as time goes on, your compounding interest starts to run wild. Your compounding interest starts to reach that point where I'm getting 64% in a return on a rental. Why? Am I smart? No. I bought a rental 9 years ago. What a genius. No, I got lucky. That's just what happens because I made a move back then that future me is thanking me for that. So you guys need to be making those moves that is going to thank you in 10 years. Now, I'll tell you this, and Buffett says this too. Don't buy shit unless you can hold it for 10 years. Don't buy investments unless you can hold it for 10 years. Because if you're buying something now that you're going to try to flip in 2 years, who the hell knows where the market's going to be in 2 years? I don't have faith that it's going to be amazing. I don't know. But if it's 10 years, it's fine. If you're buying rentals for the long term, it doesn't matter what you pay. It just doesn't. As long as it's got that decent return, because in 10 years, you're going to be fine and you're going to be thanking yourself. And the reason that I like you guys buying rentals, the reason that I like you guys loaning out money, the reason that I like you guys maxing out your 401ks, the reason that I like you guys saving money, funding your pensions, all that stuff is because I want you to have as many poker cards in your hand as you possibly can. Because life is a game, and the more cards you have that you're holding in your hand, the better you're going to be at poker. And there's ways to do it. Compound interest, retirements, savings, rentals, loans, being frugal, being smart, not wasting your money. And we're going to talk about that next. So I'm running out of time here, guys. Sorry.
Hey, Chuck.
Yes, please. Yes, Steve.
Chuck, that's a great point, a great time to interject diversity as well. And one of the things that Warren does is he because he does that 10-year theory or longer, he also makes sure that when one of his investments is losing, another one is gaining, and he can cross-collateralize that in terms of losses with government taxes. So diversity is an important part of his portfolio.
Now, Steve, you've been around the block, man. I mean, you've made more money than in one sale than probably 50 of us together we're all making our lifetimes. What kind of financial advice do you have for people? Like what types of messages are you passing along to your kids and to your mentees and all that sort of stuff?
I think that you've hit on it almost. There's no magic. You've got to hold on to and keep a reserve. An older friend of mine, he's 85 right at the moment. He might be on the call. He's me, and as you've just told us, that if you're not taking 15% of every penny that you're making.
Oops. Did we lose him, Adam? This was going to be the good stuff. We lost you, Steve. There he is. Did we get you back?
You're just not preparing for your future.
Right.
Did you hear me?
Yeah, we heard you. We heard the gist there for sure. And isn't that the truth, Steve? And I look at it too that we know this too. We know that especially guys in real estate sales and being a lender and being a title rep and being, in escrow and all that stuff, that we live in a life of peaks and valleys. We live in living high on the hog to being broke, to living high on the hog to being broke. But you have to keep your financial life steady. And you have to keep making sure that you're doing it. And that's kind of what leads on to the next thing. So, and that is getting wealthy versus staying wealthy. Good investing, and this is so great, Steve, because this is exactly what the book said too, is good investing is not necessarily about making good decisions. It's about consistently not screwing up. And it says there's a million ways to get wealthy, but there's only a few ways and a few combinations to stay wealthy. And basically, this guy, Jesse Livermore, was one of the greatest stock traders ever. He made $3 billion when the stock market crashed during the Great Depression. He did it by shorting the market, knowing that it was going to crash. And his family was worried about him because they thought, there was people going crazy with what was happening with the stock market crash. And then this other guy was a multimillionaire real estate developer who lost everything during the Depression. He was another guy, lost everything, and he was completely leveraged. Within 4 years, though, that Jesse Livermore guy, the guy that made the $3 billion, had lost everything. And I'm sorry to say this, and I'm not trying to be negative, but he actually ended up committing suicide over it because he lost everything by just making continually more and more risky investments during the Great Depression. Livermore and Jermansky shared a common trait. They were both very good at getting wealthy, but very, very bad at staying wealthy. Getting money is one thing, keeping it is another.
Chuck?
Yes, Steve.
Just one more interruption because we're gonna head toward the end of the session, and while you're talking about these things that cause people to commit suicide, I am only alive and happy because I had a partner who understood that taxes come first. You have to. You cannot make a lot of money and keep diverting taxes. You can minimize them. You can do everything possible, but you have to pay them. They have to be a priority because without it, the woe that will come into your life is just absolutely an exponential experience that you can't handle. So I was blessed with having a partner who paid taxes. Everyone on this call should make sure that they are always putting aside the money to pay taxes.
Thank you.
Sorry for the downer on that, but
hey, man,
it's really an upper to get it done.
How many people have we seen destroyed by that? So I totally agree. Totally agree. So
well, and there is an upside, Chuck, and that is that we live in the most beautiful country on earth, and that it continues to be more special than any other place that anyone has ever been, and people are still flocking here because our taxes make sense.
Correct. That's actually the truth. Thank you, Steve. I appreciate that, man. So a couple other quick things before we end here is that compounding only works if you give an asset years and years to grow. And I want you to think of it like planting an oak tree. You're not going to see any results in a year. You'll start to see some pretty good goals in about 10 years. But over the next 50 years, you're going to see something extraordinary. Because again, you're locking in payments now. I bought $2,500 in Apple stock when my kids were 3 and 5. And so far, and I just said, I'm going to forget I own this. And so far, it paid for my entire son's complete college education, and I still have $58,000 in that account. Over $2,500 investment I made in Apple 19 years ago. So the kicker with that, though, is you got to make these little moves and hold on to it and let the tree grow. Let the oak tree grow. And so I didn't know if you knew this one. Steve, did you know that there was a third partner? It was Warren Buffett, Charlie Munger, and the third partner, Rick Guerin. And they were three, and Warren Buffett still says he's one of the most intelligent financial investors I've ever met. But in 1973 and 1974, during the downturn, basically, unfortunately, Rick Guerin was margined, meaning he was doubling up his expenses and borrowing money to buy stocks in the market. And the market crashed 70% between 73 and 74. So he got so broke by having all his stuff in such risky, he was borrowing money to invest, that Warren Buffett bought out all his shares of Berkshire Hathaway for $40 a share. And the guy was completely wiped out. He put all his stuff into one, and he went big. He went all in, and then it crashed. And so, unfortunately, it's no longer Warren Buffett, Charlie Munger, and Rick Guerin. It's Warren Buffett and Charlie Munger. So that being the case, he wanted big returns, but he made the mistake. And the mistake is that we want to be financially unbreakable. We want to be solid. And we want to, when I say be solid, don't invest everything. Don't get crazy. Don't put it all on the line. Just take little pieces and put them out. Because Warren Buffett's line was, I'll get the biggest returns because I can stick around long enough for compounding to work its wonders. When people go all in on their investments, whether it's crypto or whatever it is, you're going to eventually pay the piper if it doesn't plan out. Whereas if you only put a little piece over here, whatever's going to happen. I had $2,500 in Apple stock. I mean, that was it. So I wanted to show you this, and this is the big thing. So when you're thinking about buying real estate right now, or if you're thinking about doing loans, or if you're thinking about investing in the stock market or whatever, this right here is the GDP, the gross domestic product per capita since 1850. What's funny that you got to tell me? I got to hear it. Let's hear it. I share it with the class. You know this is going to be good. All right, so this is the GDP from 1850, right? All the way up to 2010. So this is what's happened with the economy over the last 170 years. And I wanted to read this to you guys real quick. This is on page 65 of this book. So you guys can see here what has happened over the last 170 years. But during this time, this massive boom that you guys can see right here on the screen, 1.3 million Americans died fighting in 9 major wars. 99.9% of all companies that were created went out of business. 4 US presidents were assassinated. 675,000 Americans died in a single year from a flu pandemic. 33 recessions came about that lasted 48 years. The stock market fell more than 10% from its recent highs 102 times. Stocks lost a third of their values 12 times. Inflation exceeded 7% in 20 separate years, and the words economic pessimism appeared in newspapers at least 29,000 times, according to Google, during this time. So the point being that whatever you invest and whatever you do, even if you're buying now, okay, this is what happens regardless of what happens with the economy, regardless of what happens with the Ukraine, regardless of what happens with inflation, regardless of what's happening with sales prices. This is what happens to the GDP over time. So there really is no wrong time to buy, ever, because it's always going to go up. You may be buying here, oh my God, this is crazy. And look, oh, a little dip, but then what happened? And then, oh, a little dip, but then what happened? So it's really important that you know that these economic factors that are always going on are still never going to stop what's happened over time, right? Are we going to see another little drop here? I don't know. We'll leave that to people like Steve Games who've been around the block, but who knows? So be cautious and realize that staying financially healthy is inevitable, or that, you know, and make sure that you stay invincible by making sure that you have good solid savings and only investing pieces, but make sure that you're doing that. I'm going to skip this one. So this is what Steve Games was talking about. Tails you win. You can be wrong half the time and still make a fortune. And what he's basically saying is, Brad Pitt said it best when he said, I've been banging away at this. This is at the Academy Awards, right? He said, I've been banging away at this for 30 years. I think the simple math is some projects work and some don't. There's no reason to belabor either one just to get onto the next. So basically what he's saying is, you got to keep them coming. You got to keep investing. And over time, the more things you invest in, knowing that everything goes up and being diversified, like Russ was saying, being diversified is going to pay off in the long run. So you just have to take the chance of mixing it up. So 65% of venture capitalists lose money, lost money on their investment. So if there's 100 investments, 65% of them, they lost money. 2.5% of them made 10 to 20 times the amount of money that they invested. 1% of their investments made more than 20 times, and 0.5% made more than 50 times. So the point with this being that if you are diversified in lots of different things, what's going to happen is you're going to make money somewhere. And so what Steve was saying about Warren Buffett is that he makes all these different investments. Even if this piece goes down, these other pieces over here are going to more than triple it. It's going to still bring him 22% return. So it's about being consistent and constantly buying and investing. And that's what I wanted to tell you guys is, basically how you behave when markets change. Like they say this, during the few months in late 2008 and 2009, the investments you made at that time have more impact on your lifetime than everything you did from 2000 to 2008. So when things are going crazy, when things are wild, the genius man and genius woman are the ones that does the average things and keeps investing and is aware of it. Don't stop. Just keep investing your money. Keep putting your pieces to the side and just holding them and holding them and holding them. So there's an old pilot quip, and it says, hours and hours of boredom are punctuated by moments of sheer terror. So your success as an investor will be determined by how you respond to the punctuated moments of terror, not the years spent on cruise control. Because we know the market's going to change eventually, and you have to make sure that you're still making your investments at all times. So all this really call is about you guys staying in the game, making investments, having holding power, forget that you own those things, and just wait and be patient over time. And so I hope you guys enjoyed it. I'm a little bit early, I'm 1 minute early, but again, the greatest show on earth. I want you guys to start watching people and watch what they do and learn from them, both the people that are making money and the people that are learning money, are losing money. So anyways, so Tony, there you go, man. There is the psychology of money.
Love it. And that's awesome. And you gave us, this is the fourth and last part of your financial freedom. And one, thank you for sharing and this valuable information. I know that a lot of us are going to be taking this and running with it. I know I have, and you're a big part of that. So I really appreciate it, and thank you.
Thank you, Tony.
Hey, Chuck and Tony, real quick, just a little fact about Warren Buffett. I sat at a table of 8 people. I was the only person that was at the table that wasn't a billionaire. It is who you surround yourself with. You need to get to the wealthiest and most important people and learn from them. And Warren Buffett never stops learning from the people around him. No question about it. So being in a strong company with strong people and gaining everything we can from each other is the lesson that Buffett taught and will continue to teach all of us.
Thank you, Steve. And thanks for your feedback on all this, man. Appreciate it. We're out, Tony.
Thank you very much, Chuck. Thank you.
Thank you.
I hope you guys are fired up Friday. This is a fired up Friday. Come on now. Let's go.
Thanks, buddy. Take care, y'all.
Thanks, Eddie. Have a great, great Friday.